Coming up today, the bullish signal we just got from the market. Are we about to repeat 2007? Is a crash imminent? A preview of NVDA earnings, a look at the housing market, oil rising on Middle East tensions, and I get you all prepped for this week. Let's have a good one, guys. And welcome back, everybody, to the start of a fresh week on Wall Street. Finishing slightly down on the S&P 500 today, 56.16, as we stalling out at this resistance zone at all-time highs. Getting a bit of a bearish divergence on my S&P 500 oscillator. Still really bullish on market color. Getting a little bit of a pullback up the front in NASDAQ and growth stocks today. And we just got the fourth consecutive reversal signal on the technical chart here. So the market kind of consolidating at all-time highs. I mean, it's a little unsure what direction to go next. Like I said last week, I wouldn't be surprised to see a big clean break to new all-time highs this week. And we could get that on the back of really hot NVIDIA earnings, which come out Wednesday afternoon. We also get GDP data, a look at how the US economy has grown in Q2 come Thursday morning. Then we finish out Friday with important inflation data, PCE. Those are the three big events this week. Got mega cap tech a little soft to start the week off as a group, down over 1% today. And once again, it was the Russell 2000 small caps holding up the best today after having a great Friday session, which they finished up over 3%, finishing flat there today. I'll also show you a bit soon the huge volume breadth advance we got on Friday. Amount of volume going into advancing stocks, almost 12 times as much that went into declining stocks. And that's a pretty rare signal. It's only occurred 47 times in the last 45 years. Looking back at history, 85% of the time we're higher a year later. You could think of that as a big volume thrust. Not only that, the stock market is excited about the prospect of lower rates and a soft landing. When the economy can hold up, jobs market just softens a little, and the economy can enjoy a lower cost of capital, making stocks more appealing versus bonds. However, a lot of people thought that back in 2007 as well. Fed kicked off their tightening cycle with half a point cut. That was back in September 2007. Stock market loved it. S&P 500 surged nearly 3% on the back of that announcement. And I remember that time vividly. There were plenty of signs of building stress in the economy, especially in real estate. I remember the CEO of my investment bank, where I was working at the time, send out a private email to all staff telling us the US economy had significant risks with a sharply rising default rate and really low quality mortgage loans. So plenty of people did see it coming. Some made a lot of money out of the collapse of the subprime mortgage market, all those mortgage-backed securities. A few hedge funds bought credit default swaps, which was basically insurance on a company blowing up, most famously depicted in the movie The Big Short. Michael Burry, played by Christian Bale, bought some credit default swaps, and you have to pay a premium, which at the time, for a lot of these CDSs, was only 2, 3, 4% a year, paid monthly. And so when these banks blew up, they paid out 30, 40 to 1, kind of like hitting a single number on a roulette table. However, getting back to the stock market, just looking at the S&P 500 Index, at that point of time, here on a monthly chart, that was September 2007 there. See, the market rallied up the next month as well in October, just made all-time highs above the March 2000 high. Classic fake out. And then, as I'm sure a lot of you remember, we pretty much just rolled over from that point all the way down to March 2009. From high to low, the stock market came off about 57%. However, the financial sector as a whole, looking at XLF ETF, came off a whopping 84%. Financials just got absolutely smoked in that point of time. And again, another day I remember back here in March 2009, Citigroup came out with surprise earnings. Everyone had kind of written off the banks for dead. Then they came out and said, hang on, we're still making good money. And I remember that day marked the low. We had a big rip from there on out. And like Warren Buffett said about this time, it was like shooting fish in a barrel when it comes to valuations. But it was a long road back. Just looking at XLF, we didn't take out all-time highs until just before COVID. So a full 13 years later, took financials as a group to come back. And believe it or not, some of the biggest banks out there still haven't made all-time highs. Bank of America still well off those 2007 highs. However, every time's a little different, and the setup and backdrop we've got. And something we didn't have back then was a problem with inflation, which, even though it's pretty much been declared mission accomplished by the Fed and most parts of the market, the fact is we've still got global container shipping rates sharply trending upwards. And just looking at this chart with the US Producer Price Index, PPI, and a 6-month lag, you can see there's a really strong correlation between the two. That's inflation and shipping rates. So even if we do get the soft landing in the economy, that's more likely to accelerate inflation. If demand stays strong, if the stock market stays elevated, and we don't get a deep, sharp recession, we could be faced with resurging inflation. And I think it'd surprise a lot of people if the Fed had to start hiking rates again next year. But that's just one potential scenario that can occur. The market still has to deal with the inverted bond yield curve, unemployment rate ticking higher, contraction in M2 money supply, and the widely held expectation that we're about to go into a recession next year. And if enough people think that, we can talk ourselves into a recession. Big businesses pull back their investment and spending, along with consumers, then that becomes a self-fulfilling prophecy and we all contract the economy. However, Goldman Sachs called recession fears overblown, said reports of concern over US consumer are greatly exaggerated. They're predicting S&P 500 is going to hit 6,000, which will be new all-time highs by Q4 this year. But it's true, it's hard to call the stock market cheap here, just looking at the S&P 500, which is dominated by mega cap tech stocks. Definitely tilts it a lot more to the higher end of valuations. One counter argument to that is that these mega cap tech stocks dominate around the world, so comparing US stock valuations to the US economy may not be the best measure anymore. Maybe we should be measuring US mega cap tech stocks to the global economy and global stock market. However, according to Jeremy Grantham, who's been calling for a massive crash in the S&P 500 for years now, says we're in the greatest bubble of all time, says they're still finding extreme discounts and deep value stocks, and that'll be the best place investors can position themselves to weather the upcoming storm, especially pointing outside the US as a place that has much more cheaper stocks, calling some extraordinarily cheap, and especially looking at small cap value stocks outside the US as well. And just keep in mind, looking back in history, when the Fed does cut rates, which is pretty much guaranteed to happen in about 3 weeks from now when they meet up on the 18th next month, small caps on average will slap on 26% in the first 12 months after the first Fed rate cut, easily beating large caps by more than 10%. And the cool thing about investing on the New York Stock Exchange is it offers exposures to companies all around the world. That's thanks to American Depository Receipts, ADRs. Foreign companies who are listed on their local exchange also listing in New York, offering an avenue for American and global investors to invest in their companies. And so there's plenty of choice out there. Actually, stock pick number 12 I gave out to my paid members over the weekend is a company from Argentina, which is deeply undervalued and I believe has a lot of potential. And it's got the tailwind of Argentina being the best performing stock market this year. That's thanks to Javier Milei, who's in the midst of orchestrating a massive turnaround in the economy of Argentina, bringing inflation down, and that is starting to benefit a lot of the companies there that have been beaten down and left for dead by international investors. And so there's plenty of choice out there when it comes to investment option. Even if you do think the US is significantly overvalued, that's just one segment of a global market. However, don't be fooled. Cheap stocks are not always a walk in the park. Cheap can get cheaper. We just saw that with Pinduoduo, Chinese owner of online retailer Temu, falling the most on record today just after it reported quarterly revenue that missed analyst expectation, with investor concerns growing about slowing growth and reduced profitability due to increased investments. And so this is an ADR, American Depository Receipt. Stock got smoked today, falling 28% on huge volume after it had been having a pretty good last 12 months of trading. Just goes to show there is plenty of risk investing in cheap stocks, and China is still not out of the woods just yet. But getting back to America and the here and now, the real big one this week, NVDA earnings after close on Wednesday. The last mega cap tech to report for the Q2 season. Stocks already up over 150% this year, doing a lot of the heavy lifting in the S&P and NASDAQ indices, and the street and the market is pretty much expecting them to blow it out of the water again, come in above expectations. We've been hearing a lot of their customers saying they're still spending big on NVIDIA GPUs, so it'd be very surprising if they didn't come out with a big beat. What the market's really going to be paying close attention to is their guidance and whether they still see all their customers increasing their spend on GPU and AI. At some point, they're going to come out, whether it's this quarter or in however many quarters in the future, and say their customers are pulling back on their AI capex, and that should really change the mood and sentiment in the stock, send it sharply lower. Doesn't look like we're about to get that this Wednesday. However, just like the S&P 500, NVIDIA is also stalling out at all-time highs. Market's kind of testing it here. Does have a big bearish divergence going on the DSI. However, it could easily smash through to all-time highs on a really rosy outlook and guidance from Jensen Huang come this Wednesday night. And so if we get a good result and reaction from NVIDIA, that could carry the market through to a week and a half from now when Apple gives its iPhone event on September 9, in which this is said to be a pivotal moment for the company as they step into the AI age as well with their new IntelliPhones, integrating AI functions into the new iPhone 16. That could also get the market excited. But we can't escape what could be a hotly contested US federal election in just a little over 2 months from now, and the VIX seasonality, which takes us up into that point of time. Even in a normal year, it can be volatile, and so we're not out of the woods yet, either with seasonality and volatility. And one area of the market that doesn't get a lot of attention but could also present some risks is real estate and housing, and kind of different from back in 2007, 2008, where it was more of a debt crisis, really elevated levels of household debt and all those low doc or no doc mortgages. 5% or less deposits. A lot of people just piling up 3, 4, 5 houses. All came tumbling down. However, ever since then, we've had really loose credit conditions, which has still stimulated the housing market. And this is looking at in America, but I can tell you in other countries like Canada, Australia, New Zealand, the valuations are even worse. You're looking at a long-term chart of inflation-adjusted home prices from 1890, and you can see up until about the mid-1990s kind of hovered around an average around 150. In other words, houses pretty much went up with inflation. It wasn't really considered a really big investable asset class that you just expect to go up 10 or 15% every year. However, we've had government policies that have stimulated investment. We've had really loose credit conditions, low interest rates, and more people become property investors. All of that has pushed up the inflation-adjusted house price to all-time highs, almost double the 130-year average, and what some call the biggest housing bubble of all time. And another way to value housing is looking at the monthly cost to buy a house, drawing a bit of a regression line through that, kind of a mean average trend line, and just looking back at the last 50 years. In the States, that average mean valuation would suggest a monthly cost to buy a house should be around $1,800, where right now it's actually above $2,800. And looking back in history, just like a lot of valuation measures, the price will swing up and down, above it and below it. However, there's always reversion to the mean. Just don't tell that to a lot of real estate investors, because they'll give you a good reason why it's different this time. But it's true with what Macquarie say. Home prices won't fall meaningfully without significant job losses, just like we saw in 2008. Kind of a ripple effect. A lot of people losing their jobs, and they've got heaps of equity in their real estate. What do you think they're going to do? They're going to list their house for sale along with their neighbors. Then the market gets flooded with supply. And just like basic economics will tell you, when supply goes significantly up and demand goes down, the price gets created. And just moving on to the macro, we've got treasury yields ticking higher to start this week off. Not much out on the economic calendar today, as is usual. Market will be really waiting to see what GDP comes in on Thursday and PCE inflation on Friday. Still starting off a bit soft here, 393 on the 2-year and 382 on the 10-year. And once again, just like last week, I'll be looking for this big support zone to be held. So we continue trading lower on the 10-year. That's the bond market really saying they're seeing a recession just around the corner, and they think interest rates in the States are going to be lower for a longer time. We'll also be watching the dollar this week, which is really technically oversold here in the short term. You can see my reversal signals indicator firing off. DSI is oversold, starting to hold ground. Be looking for a bounce here after that's been trading really heavy this last month or so. And that's another reason that's prompted me to invest in ADRs. Because when you own some shares in a foreign company listed on the US exchange, if that foreign country's currency appreciates against the US dollar, that makes the value of the ADR go higher as well, in addition to however it's trading on its local exchange when it's translated into US dollars. And the way this US government is spending, there could be pressure on the US dollar potentially a long time to come. And I'd say that's a big part of the reason why gold's been trading well this last month or so as well. And just looking at some research, what some say are the 4 big forces that will challenge the dollar's dominance going forward. And you could say it kind of already is being challenged. We're already seeing the dollar's share of global reserves being pretty much declining this entire century. Starting in 2000 above 70%, now in the high 50s. Central banks look to add more gold to their reserves. Many countries aligning themselves more closely with China as they're a bigger trade partner. BRICS nations getting a lot of momentum, getting a lot of cohesion, working together, and that's because of US sanctions. The US dollar reserves allows the US immense leverage over other countries, being able to enact their political will upon them, which of course is no surprise they don't like. US debt, I'd say, is the biggest threat to the US dollar's value and dominance. If the US dollar ever does get really created one day, that's really going to erode confidence in big investors holding a lot of assets denominated in US dollars, especially if China becomes more trustable by investors, because they do have a much cleaner government balance sheet, less debt. Improved payment technology, Bitcoin, blockchain, that's all a threat to the dollar, along with central bank digital currencies, making it much easier for other countries to trade and transact in their local currencies instead of having to do it through the US dollar. However, this is all a real long-term trend and threat. US dollar's not going away anytime soon. It's just not moving in the right direction. We got oil starting the week much higher today, more than 3%. We just heard news from Libya suspending their oil production output and a few escalating tensions in the Middle East, with Israel doing some preemptive strikes on Hezbollah, blowing up thousands of their missiles before they can be used. Still not in the clear over there. And just like I said last week, when Ukraine did its most aggressive incursion into Russia, sending drones into Moscow, like I forecast would see a big response from Russia, and that was the case. They just carried out the largest aerial bombardment of Ukraine, targeting energy infrastructure, with President Zelensky now urging allies to allow Ukraine to use long-range Western-made weapons. He wants to dial it up further, keep attacking inside Russia, and it could be not only Zelensky, but a few other key figures, companies involved in all this. Maybe want to see a bit of a showdown before the US federal election. Maybe there's some people out there that see a closing window of opportunity. Because if Ukraine keeps stepping up its attacks back to Russia instead of just defending itself, then Russia will keep dialing up their responses as well. It may actually force the West to really step in there. So both in Israel and Ukraine, still the risk for it to spill over. And so it's no surprise to see crude oil supported, bouncing pretty good off this support zone last week, $72 a barrel. Now back sitting at the 50-day, $77 a barrel. Also interesting to hear Exxon say today that oil and gas will still be the dominant sources of energy by 2050, with them saying oil demand to stay above 100 million barrels per day through 2050, and they predict only 6% of energy by then will come from nuclear. However, of course, they're just talking up their own book as an oil company. It's kind of like Coca-Cola coming out and saying Coke will still be the biggest source of obesity by 2050, which who knows, could very well be the case. Another interesting chart I thought I'd share with you guys today. The value of $1,000 invested in the best places to work versus the S&P 500 Index from 2008, as ranked by companies on Glassdoor, where employees can go and leave reviews about the company without identifying themselves. $1,000 invested in 2008, each year in the top winner would have grown to $6,500 by the end of 2019, S&P 500, $3,500. And so anyone can see the best places to work on Glassdoor. Here's the list so far for 2024. Not all the companies are listed on the stock exchange. Interestingly to see NVDA coming in number 2. Got Delta there at number 13, Adobe 15, Microsoft 18, Eli Lilly, Lululemon, which has been really beaten down of late, pretty cheap for a growth company, Cisco, MasterCard, and CrowdStrike coming in at number 40. Anyone remember that a bit over a month ago when half the world shut down for a day thanks to CrowdStrike? Stock got slammed down, had a bit of a good bounce off that $200 level. And just looking at this Thursday, Goldman Sachs expects GDP growth to come in at 2.5%, a little bit lower than consensus 2.8. They expect weekly jobless claims to come in 225,000. We're really looking for this number to stay under 250,000. If we get a 4-week moving average of weekly jobless claims above 250,000, it'd be kind of hard for the unemployment rate to not start spiking above 4.5 with that. Friday, PCE Index, they expect month-over-month growth of 0.13%, year-over-year 2.52%. A little bit better than consensus and pretty much matching that of economic growth. And that's ideally what you want to see. Economy growing a little faster than inflation. And starting off the week, Fed Fund futures pricing in 68% chance the Fed will cut rates 25 basis points next month. And we'll watch how this evolves this week after GDP and PCE data. But like I said, the real big one this week is Wednesday night, NVIDIA. Semis trading pretty weak here today to start the week, stalling out near the top of their range. There's a look at the sector ETF. Really important sector. It's kind of been leading this bull market from October 2022 lows. Could potentially be a topping formation at play here. And either way, it's going to have a big impact on S&P 500 this week. Whether we can get a clean break to new all-time highs or whether this bearish divergence may play out, or on the other hand, we may consolidate and then do a fake out to new all-time highs before rolling over, just like late 2007. Either way, we'll keep a close eye on it all, and I'll keep breaking it down every day this week for you guys. Thanks for sticking with Click Capital, and I'll see you again tomorrow night. Cheers.